Hey everyone, welcome back to the channel. This is your weekly review for August 24th through 28th. Quick reminder before we start. This is educational. It's how I read the market with the Conflux method, not a signal service and not financial advice. Trading futures and options carries a real risk, so take this as a walkthrough of my thinking. Let's get into it. First, a look back at last week, then the week ahead. Let's start with last week. Bessent decided to do a bit of intervention in the domestic market too, announcing a doubling of the limits on the buyback of government bonds. The buyback runs from September 9th to November 4th, so weigh up how strong the risk appetite is going to be. Essentially, they're timing this program to the elections and the Fed meeting, trying to paper over all the negative. The main thing is that they've flagged their pain point on the treasuries, and the market now knows it and has remembered it. In the end, the buybacks are only $4 billion. Just like with the yen interventions, carried purely verbally with a statement. And I don't think that's enough to hold the market for long. Overall, last week, everything moved in the direction we talked about. I managed to get in a little with market orders. In some places, we didn't reach the limit orders, and in others, we're simply still moving in the right direction. Now, to the week ahead, and let's start with the euro. Interesting options showed up. The central and the first and second strikes are sold. They've shown the working ranges. Above 1.1988, it's almost unrealistic to get through. This straddle is very interesting into Wednesday. And given the day's balance at the open, it's attractive for longs on a pullback and for sells on a push-up. For now, the main plan is to buy it back. A ratio of at least 1 to 3 when taking profit on both buys and sells, and the remainder just left in the market at break even. That's it. Briefly on the pound. Here are the zones of Wednesday, the week, and the quarter, and the chances of reaching and breaking through them. Now the Australian dollar. The zones of Wednesday and the contract. The weekly one is useless because it sits right next to the contract boundary. From the open, I'm very interested in working these intraday zones. At 0.712. 2, they added 700 contracts as support, almost at the high. So I'll definitely try to buy it back. Until expiration, the 73 strike is almost unbreakable. Now, to gold, and here's what's very interesting from the open. 4,530 and 4,543. I'll definitely work. Right at the open, there's support at 4,642 to 4,644. But that's only within the first 1 to 2 hours after the open. 4,593 to 4,595. I'm interested in for the market buys until the Japan close. Up top in the zones, there are slabs too. Volumes went through on these strikes. There's support there. Also, off exchange, 1,100 plus puts went through with a break even around 4,430 on the next contract. $12 million worth. For now, there's a very good chance of reaching these options, so I'll leave it as a target for reference, and if it plays out, from there, I'll look at shorts. And those guys shorted at the highs. The break even was clean there, but by the close, the strike emptied out, so watch the open. If they try to break 4,530, then 4,315 starts lighting up, and very strongly because the max pain for September 20 hangs there, and I doubt they'll leave that debt. They'll paint that move if Bessent deflates on the Treasury buybacks and they go back to conquering the highs, briefly on rates. Just as the speculators work against the Bank of Japan, they can now start working against Bessent. So far, he's only threatening verbally with buybacks, and there are no specifics on the purchases. $4 billion is laughable for this market, where tens of billions trade in a single day. So the funds in the Treasury could start terrorizing it and drag the 30-year up to the 6 to 6.15% region before the Fed even steps in and brings it down to 5% as a first target. But only a rate hike can do that. Jackson Hole is the intrigue of the week, and the question is whether Warsh finally gives some specifics or just spreads fog again. And briefly, today I looked at the yield on French 10-year bonds. and it's already higher than Italy's. A positive spread for the first time in history. France's 5-year CDS, the insurance against default, is already higher than Italy's too. Among the large economies, the main problem country in Europe has always been Italy. Romania's situation has always been even worse. But the size of their economies and the impact of possible problems on the whole region isn't comparable, and France has always been the core of the European economy, after Germany. That's exactly why the current structural changes in how risk is priced matter so much. French 10-year bonds should keep rising. That is, you can actively short them, and the main risk is the French banks. The bonds have already spoken. The CDS confirmed it. What's left is to wait for the banks, and this could become the main macro theme of the year. We'll see. That's the plan for the week. Remember, these are zones and scenarios I'm watching. The market decides, not me. So let price come to your levels and let the confirmations line up before you act. If this breakdown was useful, subscribe and turn on notifications so you don't miss the next weekly review, and drop a comment with the instrument you want me to cover. And one more time, so we're clear, none of this is financial advice. I don't sell signals, and I don't promise profits. This is educational content about the Conflux method, and everything here is my own view of the market. Trading futures and options involves a substantial risk of loss, so never risk money you can't afford to lose, and always do your own analysis. Take care, manage your risk, and I'll see you in the next one.